Good morning to you all. I'm Hafian Rashid from the class of September 2021 of MBA program in IPMI International Business School. Today, I would like to present to you what I learned in corporate finance class. Okay, but first of all, I want to thank you to Professor Roy for the class learning experience and for sharing his vast experience in the finance world. I hope I can learn more from you, Professor, in the near future. Okay, so what I learned so far in the corporate finance class is about financial management, capital budgeting, security analysis, capital structure, fraud risk management, and corporate restructuring. This is the most I find it very interesting regarding the corporate finance. So what is corporate finance? So corporate finance, how we put it simply, is an art. It is aimed to know how business fund their operations in order to maximize profit while minimizing the cost at the minimum least of possible. Now, if we want to invest in some stocks, bonds, deposits, or any kind of investment, we need to know the basic. So we need to formula to tackle all of that, all of the investment instrument by first thing first. In the financial analysis, we can use, like for example, the future value of a money that we want to invest. Like we can use the future value in order to know how much investment is worth in the time future. It presents the value time, the present value of cash times 1 plus the annual rate, interest rate, to the power of how long you want to invest. Now, in reverse, to find the present value of our investment, say you have a target of how much money you want to earn, is by future value of how much target you want to achieve divided by 1 plus the annual interest rate to the power of time how long you want to invest. Let's say you want to invest in 1 year, 2 year, 3 year. That will be the denominator for you to invest. Now, not only regarding about future and present value, we also need to find the risks of our investment using the capital asset pricing model. Capital model is by search the risk-free rate investment, especially in a country, for let's say Indonesia, plus the beta of risk. Let's say if we want to invest in the stock, we have to calculate the risk itself, not only the risk from the stocks, but the company that we want to invest, and then times the expected return by the formula of the risk market deducted by the risk-free rate of the country invested. Last but not least is to calculate the weighted average cost capital of an investment. A firm weighted average cost of capital represents in a blended cost of capital across all sources, such as common shares, preferred shares, and the debt of interest-bearing debt that we issue from a loan. The cost of each type of capital, it's weighted by its percentage of total capital, and they are added together. This guide will provide the detailed breakdown of what weighted average cost capital. Now, besides all of that formula, we also want to know the risk and the return of the trade-off we want to invest. For let's say, portfolio theory of regarding systematic and unsystematic risk. For example, we cannot predict any type of risk, but we can assume some risk that need to be mitigated. That is called the unsystematic risk. Why? Because it consists in the micro view of an industry that we invested. Like, let's say in company XYZ able to achieve poorly due to the inefficiency and effectiveness of their invested capital. That is the unsystematic risk that we need to predict in the company. Now, well, the systematic risk is the risk that we cannot avoid it and there always will be there. For example, like there is a disaster or war, a world war, like it's in a big scale in a macro view. For example, in this era is like pandemic COVID-19. That is something that we cannot predict and we cannot stop regardless of how much we want to mitigate our risk. So in order to do that, we do not put our money in one basket. I remember in Professor Roy that we have to diversify our portfolio in order to mitigate the risk itself. The risk itself is beta. The 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 before formula that we discussed, it's the beta. So how do we do this? How do we start the analysis of regarding the company that we want to invest? So we first have to know the technical analysis of the moving of the stocks. For let's say if you want to invest in company ABC, you need to know the pattern movement of a company, like the patterns movement of the stocks, like PT ABC have a moving average conversion divergent at a range of price in 2000 to 2200, something like that. Or we can also provide the technical movement of head and shoulder or any type of stocks movement that may predict the future movement, so that we may able to achieve profit and not achieve loss. Besides technical analysis, we also use fundamental analysis, that we search the news or the information regarding the company that we want to invest. At the ABC have a financial statement report that we can analyze by using the financial ratio analysis. We can do this by calculating the liquidity ratio, the profitability ratio, the leverage ratio, the solvency ratio, any kind of ratio that might able to decide where our investment should be put in. So for the special topics, we also for the starter, we can also use investment simulation. Like there are many trading apps that that nowadays can be provided if you want to try out how stock investment simulation can be used before we use our real money, our real investment into the real world. Now, for example, leverage buyout, it's a type of company topics that regarding that we want to save or bail out a company that is in danger. For example, in the real world, Lehman Brothers, when the subprime mortgage era, he tried to bail out his his banking business by asking Warren Buffett to bail out his company. But the bailout was a failure, and Lehman Brothers goes to bankruptcy. Fraud risk management also like to have also have a unique case of Enron where they misappropriated or misguided the investor by uh, by by overstated the financial statement in the in the financial report. So all of that is type of example in the real world that that is can be learned from real lifetimes. Other than that, we can use the investment simulation to further our skills in the investment strategy or the stock strategy. Now, regarding financial management, we discussed the financial aspect of corporate finance. But as I say, corporate finances are not only that we study regarding numbers, but we also study regarding the social aspect. The social aspect is regarding about the fraud risk management and how good corporate governance apply in the company we invest. So in the financial management, we also learn the capital structure, management fraud risk, management asset liabilities, management cash flow, and revenue management. So all of that is controlled by the company governance. The good corporate governance that we use are probated by, it's called tariff, which means transparency regarding the information that we need to get, accountability of the company that we want to invest. Is it have the sufficient human resource? Does it have the sufficient management, or does it have the sufficient asset that it needs to accumulate revenue in the future? Responsibility of the shareholder is also important because it holds significant trust of the shareholder in order for them to invest. So responsibility and accountability of a company that we want to invest is really important. Independency also also connects with how the company not affected by any kind of factor that that we that in result creating a bias operation of the company. So the company need to have independency that which not affected by any factor from outside the company, and also fairness of how they treat the shareholder and how the people in the company operate. Now, as I mentioned, financial management is optimal orchestration of internal, external, and external financial resources towards significant of sustainable value of creation. Now, imagine if we have, if our board of directors need us to find a new project for our investment. We can use capital budgeting, net present value, internal rate of return, payback period, and profitability index to identify which project can provide us the most profit. If, in example, I have 1 until 5 investment project that I need to assess. This five criteria will help me to identify what profitability that give us the best results while minimizing its cost in investment. For that, we need to learn the value of 4 cornerstones in corporate finance. First is the core value, conservation value, expectation treadmill, and the best owner. We need to know what investment that we want to put it. If it has the core value that we want, have the same alignment that we want to invest, it's a yes. Conservation of value is how we want to give the best result, but with the minimizing costs. Expectation treadmill is how far that the investment will have the expectation that I want in return, and what is the best owner of the investment that I invested. Financing can also be affected by capital structure, management, and tax signaling. Now, goals of the finance firms: maximizing profit and maximizing shareholder wealth. And now the true goal of goals of the finance and the firms is to have a dividend policy in order for the shareholder to have a trust in the company, even though it's not significant. It's not mandatory for the company to give dividend policy, but is a way how the company appreciate the company itself. So the goals of the finance firms is to maximize profit, maximize shareholder wealth in order to give dividend in order to have capital gain and give dividend to the shareholder. Now, from the aspect of the social, fraud risk management is because people are pushed by these factors. Fraud of triangle is in the circle of these 3, is the factor in these 3 results in rationalization, opportunity, and pressure. For example, rationalization, we are very very greedy, no, very greedy personality that we want to achieve more money, more power, and as Professor Roy once said that greed is good from the from the movie uh, from the movie of Wall Street. Besides that, it's because of opportunity that people came once in a lifetime that they might able to achieve more wealth by the opportunity they get that happen once in a lifetime. For example, that if we want to have that we are able to achieve uh, like we have the access to the company money, we tend to have that urge uh, to rob the company's money. The third is because of the pressure, like financial, because we don't have a lot of money that, and we don't we think that we don't have enough money, that is the pressure of we will do fraud in the first place, or because of the work that we think that the work that we do isn't compensated well with the salary that we gave or the benefits, so we might able to push ourselves in order to do fraud in the company. So what does the company needs to prevent all of this? The company needs to provide good corporate governance and protective security, employee ethics, and whistleblower mechanism. So we need to have the norms and the value applied to the company in order to the employee not to be not to not to have the urge to do fraud in the company. Not only that, but we also need to ensure the benefit of the employees in order to subdue or mitigate the risk of the fraud itself. So that is all what I learned from the corporate finance class. If I do have any mistakes or two, I'm sorry, but Professor Roy said that it's okay to make mistakes because you are still learning and growing. Okay, thank you so much for your time and attention. I hope it helps, and see you next time.